It is 7 o'clock and we are going to get started. Welcome, welcome. Thanks for joining in. First of all, welcome to our first webinar. Many of you know I've been doing videos on a weekly basis, and so if you've been checking your emails, you should be getting those. Some of the information that have been covered in those videos will be shown again here tonight, so that everybody knows this meeting is being recorded. And so that's why as we go, I've got everybody on mute. And so if you have questions, please feel free to type them in the chat box somewhere on your screen. There should be a place for a chat box. Hey, Dennis. And feel free to ask questions. We are recording this with the intent that for those that do not make this webinar well, and so we're going to be breaking that into maybe into chunks depending on how long we go, but we'll be sending that out as possibly a link for everyone else that couldn't attend tonight. So first and foremost, welcome. This meeting is meant to replace what we have done the last 4 or 5 years in a row with at Leinie's Lodge. And so as you may assume, yes, the attendance is a little lower since we don't have beer on our webinar, but feel free, if you are at home, to crack a beer if that makes you happy and makes you feel more like we're at the lodge, I guess. So anyway, welcome. And so what I have for an agenda for today is we're going to go through and do an investor update. And I'll give you some ideas and strategies of things that are going on and things that we see here. And so let's move forward. And so one of the most important things in the world is your health. And if you don't have your health, what do you have? So I hope everybody is eating their vegetables and boosting their immune systems and so on, because you can have all the money in the world, but you can't buy your health. And with that being said, there are basically 5 key areas of financial planning: preservation planning, retirement, tax, estate, and investments. Tonight, primarily, our focus is going to be on investments. And the stock market has been a very rocky roller coaster, and I'm going to do some I'm going to throw some charts up to kind of put you or show you a perspective of how we have been doing this year and how it looks historically. And the first half of this year looks like this. So this is the S&P 500. We started off January and February pretty strong. Of course, we know what happened in March, and that turned into dropping over 34% from its peak. And then we working our way back in its recovery. And so that's the first half of this year. And the second quarter of this year, the Dow was up 17%, S&P is up 20%, NASDAQ was up 30%. The second quarter, the ACWI, which is an index that we use quite a bit here, it was up, and it again follows right along. But what I wanted to do is put this in a little bit of a perspective, and that is looking at this is the market year to date. And so when we look at the second quarter, we can see obviously we have some positive growth, a lot of volatility, some positive growth, but that's all following the first quarter where the markets dropped. Looking at it from a 1-year perspective, from June 30th till June 30th, so you can see that the third quarter of last year was basically flat. Fourth quarter of last year, we had a little bit of a climb, pretty boring, nothing too much going on. And then the first quarter, we see that big drop, and then it's reversed back. Putting that, and that's the 1-year picture of the market. In perspective, this is a 2-year picture of the market. And so when you look at it on a 2-year, the market, when it backed up quite a bit. It did, as of the end of June, our market was basically where it was 2 years ago. And if you look at the 3-year chart of the market, one of the things I'd like to point out is notice the volatility, the steepness of this drop that we had here in March, and the speed within which it happened. In fact, if you look at it on a 5-year chart, one of the things you can see is when the market bottomed out at the end of March, it was the same as what the market was back in 2017. And that's a lot of work over a long period of time that we lost, and it backed up. However, we have also had a rebound since then. This is a 10-year chart of the stock market. And so if you look at this from a 10-year perspective, you can get a nice feel for, again, the vertical cliff that we fell off in March and then its subsequent rebound. And this is actually a 20-year chart of the stock market. And this goes back to right after the tech bubble, where the market dropped in 2001 and 2. 5 years of rebound, and then we lost it all in 2008. And what was interesting about 2008 is it actually started in October of 2007 and went through March of 2009. So that was a year and a half is what that drop was. And if you compare that to the fact that ours came down in a month, it shows the sheer volume of and the speed and the volatility that we had when that took place. And this is a chart that goes through and shows year to date. And this is through, I put this chart together, and this is going through from January 1 through this year. And I was, as many of you know, we have our red lights and green lights that dictate to us the signals and what percentages we're going to have in the stock market versus the bond market. And we had so many trades in such a short period of time that I changed how our charting is done here a little bit. And so for those of you that are in our all equity portfolio, which means that it's called the 100-0, this is the equity. This is how our percentage of stocks versus bonds, how we've managed it through this whole thing. And for those of you that have a little bit more conservative accounts, this will be for the equity portion, meaning if you were in the 80-20, we always have 20% in bonds. This would represent the 80%, the equity portion. And then for those of you that are in our 60-40 portfolio, always has 40% in bonds, this will represent the 60. And one of the things to notice is as we were at the beginning of the year, as the market was coming up, we were 100% of our equities was in the market. And right at the beginning of February, as the market started to come down, we pulled it back to 80%. We were 20% fixed income, and we were 80% equities. And that was fine until the market started coming down. The beginning of March, March 6th, we dialed it back from 80% down to 60%. On March 8th, we dialed it down to 50%. And finally, on March, it was about the 14th or so, that we just decided to pull 100% of our equities and sold all. And a lot of that money sat in cash. A lot of that money was still in bonds. And we decided not to participate in all of this craziness. And over the next week and a half, the market dropped 11, 12, 13%, and we did not participate in that. As the market started to come back, and actually to back up, everybody that was in our advisory programs where we're making those trades should have received a phone call from someone in our office. I was actually in Texas, and we made these trades, and so everyone in the office was on high alert, calling everybody and letting everybody know that we made these adjustments. As the market started coming back in the beginning of April, we put our toes in the water with 20% in equities. Then we raised it up to 40% equities, and then we got back up to 60%. We had some volatility that started to come back a little bit, so we dropped it back down to 40. We bounced between 40 and 60% in equities, and so the green represents equities, or the stock market percentage. The blue represents our fixed income or cash. And then getting into the end of May, we got into up to 80%. And as of July 1st, we are actually back with all green lights. And so what's interesting is is if you look at this chart, if you look at it as a whole, about 40% of the time, or we were in bonds or cash, and about 60% of the time, the green, we were in the market. Now, a lot of investment advisors, what they'll do is they'll put 60% in and 40% in fixed income, and they'll leave it like that. And they're like that all of the time. And a big adjustment might be going from 60-40 to 62-38 or 58-42, and there's a big adjustment there. Well, for us, not quite the same. We went from 100% into the market to 0 in the market, back to 100% in the market. And we believe that 13 different times this year, I made the accounts either more conservative or more aggressive based on that. And so we have been very active and very diligent with these portfolios. The good news is that we can make all the trades in the world and it does not affect your fees. We can make 4 trades like we did in 2017 when it was a very boring year, or we can make 13 different sets of trades and it doesn't cost you any more or less. We have unlimited trading platforms. So does anybody have any questions? If you do have a question, feel free to type it in the chat box as we go. Anybody have any questions about the equity exposure or the things that we've been doing so far this year? We've from January 1 through July 28th, the stock market was still down. Most of our portfolios, however, we are performing very well compared to the markets, and I'm very pleased with how we're sitting. This is my first webinar, and I got to be honest with you, I like being in front of crowds and get to see how everybody's reactions and what they're feeling and stuff. So I hope you are happy with what we've done here. I'm happy with the performance. I'm happy with taking volatility off the table when it looked like the world was going to pieces. As of today, we are all green lights, and so we are sitting in a very positive market, which is confusing to a lot of people and so on. So that's where we are year to date. I'm going to move forward if nobody has any questions. All right, because I can come back if you like. Okay, so at the middle of the year, when the markets, I'm at the mid-year, bond yields are extremely low, and I'll show you how bonds are doing. Gold prices have been rising. Unemployment has been as high as it's been since the Great Depression. Oil prices are rebounding from their lows, but they're still down. Chinese factories are making more stuff than they ever have, and the disease experts are warning about what happens if they lose control of COVID-19 outbreak. And so that's where we were. Now, this is a great chart, and I like this chart because it shows us since 2004 what's been happening with interest rates. And you can see when we were in very strong economy back in 2005 and 6, and the Fed was raising rates and raising rates and raising rates, and it got into the credit crisis back in 2000. The fall of 7 is when the Fed cut interest rates right away, and then they cut them again in 2008, cut them again, and brought it all the way down to almost basically 0. And interest rates for the longest time, all the way through until 2016, were basically nothing. And after that, as the economy started to improve again, it took us quite a while to recover from the credit crisis of 2008. The market started to climb up, and you can see the Fed raised rates, especially after the elections, and in 2017 when the market was strong, and 18. And the Fed then instantly this spring in March just slashed rates right down to 0. In fact, I refinanced my house, and I got a 30-year fixed rate mortgage at 3.0%. And that's about as low rates as I've seen, except for, of course, my uncle, who's slightly competitive and had to beat me at 2.875 fixed for 30 years. So those of you that have interest rates that are 4, 4.25, 4.5, 5, give me a call. We should take a look and evaluate if it's worth, makes sense. I will say going through the refinancing process today is a complete pain. There's more bank regulators than there are loan officers, and it's expensive. And yeah, it's one of those processes that you have to be committed to it. But it's, I figure at a 30-year fixed rate, yeah, we're at 3.0. You will not see me paying that off early. With the idea being that if I can't beat that in the markets, I'm going to fire me as my investment advisor. So that seems like a good thought. Bragging about beating me mildly, that's okay. It's all right. I'm not competitive. All right, so here's where we were a year ago compared to last week. The Fed funds rate was 2.37% a year ago. Last week, 0. Money markets were basically double what they were. The 12-month certificates were well, the CDs, we still call them certificates of depression because they don't seem to be making any money no matter what, but we're at 0.4% now for a 12-month certificate. And this is GDP in the United States, gross domestic product based on by quarter since 2009. You can see as we come out of the credit crisis in 08, the market was or the economy was bad. But then we've had basically growth in the GDP until this year. And as you can see, it was significant. In fact, our gross domestic product dropped more than it did in the tail end of the credit crisis. This is an interesting chart, and it's talking about the different types of market recoveries. And how this works is some people think that we might have a V-shaped recovery, which is what we've had so far. It dropped and then it rose right back up. A W-shaped recovery would suggest that if we're at the middle of the W and maybe the market's going to drop and do it again and retest lows. That's a common type of market. An L-shaped recovery is one where we have a sudden plunge and then it takes a while for it to get back. I would suggest that at this point we're in a V-shaped recovery. Whether we end up in a W-shaped recovery is hard to tell. I did hear of, I was listening to a podcast from another financial advisor who was talking about another letter to describe the market recovery, which is a K-shaped recovery. And that was interesting to me. The idea behind the K-shaped recovery is the market drop, and then from here, the rich will seem to get richer and the poor are going to be much worse off. And so that's where that's a different type of thought process. I don't know what we're going to have, but these are the different types of economic recovery paths that are out there. Which one we have, we don't know, but we are willing to be flexible and make adjustments for this to no matter what kind of market that we're going to have. From here, where do we go? And that's really the big question, because some suggest that if we have that the Fed seems to be very comfortable printing money, and they are printing a ton of money. And one would suggest that if they print that much money, that it should devalue the dollar and that inflation should kick in. Back in 2008 into 2009, when we were going through the credit crisis, the government, instead of just coming out and saying, we're just printing money, they called it quantitative easing. And they had a QE1, QE2, and QE3, which was quantitative easing. And basically, they printed what? They printed all of this money, and the conjecture or the thought process back then was that it would devalue the dollar, and that the markets or that the dollar, we would have super inflation, and none of that took place. Now, why that is, I don't know, other than maybe maybe it's we're the strongest superpower in the world economically, and no one's going to question the validity of the bonds that are being issued by the government. But apparently, the government decided it's okay. We're going to just bail our way out of this mess by throwing money at it, and they're doing it in the trillions. And so, whether we have a horrible reaction to this, or we have a favorable reaction to this, the history books are going to tell. But there's a lot of different ways we can go, and we believe in with our tactical investment approach that we are really well positioned to handle any sort of market that's going to come. If the markets are going to crash, that's all right. We'll pull it out. We're not afraid to. We've done it before. We'll do it again. If the markets are in recovery mode, we'll participate. And if we're in a bouncing mode, well, we're just going to get in when it's good and get out when it's bad. And that's the type of investing type program that we have. This is a neat chart talking about the average bull market since the 1950s compared to the average bear market. And the average bull market lasts on average of 72 months, which is 6 years, with a market total return of 279% on average. The average bear market is much shorter in time. It is an average of 14 months with a negative return of a negative 33%. So when you look at those numbers, we know that this has happened. It's happened before 1957, it happened in 65 or 63, and it happens every decade or so. It's just part of what it is to be an investor. And volatility. We have record volatility, almost record volatility. Back in 2008, we had a lot of high volatility days, and it took until 2009 we had a lot of volatility. 10, it started to calm down, and so you can see that in 2017 we basically had no volatility. We had no trading days. It was just a slow, steady market increase. Well, guess what? Volatility is back, and we've had a lot of days where the market traded more than 2.5% in one day or another, and we're only halfway through the year. And so volatility is back. And so this volatility gives us a moment to pause and to think about, what sort of opportunities there are out there for us. And a few things the government has done is they have waived required minimum distribution. So if you were over 70.5 in the past, or 72 when they changed the laws, and you have required minimum distributions, they have been waived for 2020. My staff has been under particular guidance to make sure that if anyone's about to take a distribution, that we're calling to check and see, are you sure you want to do that? Because what it is doing is increasing your tax liability, and you may or may not want to do that. And so it's important to understand that. And that here's the thing, it's not too late. If you did take out a required minimum distribution out of a retirement account already, you have until the end of this month to put it back and not be taxed on it. And so we have a few more weeks for those of you that have automatic required minimum distributions. You do not have to take that money out, and it's not too late to fix it. So feel free to contact us. Again, for those of you that are watching this, it's for those that are over age 72. We have some ideas that we can do portfolio rebalancing. And when I talk about portfolio rebalancing, it really gets into if your timeframes have changed. And when the markets drop is when we can have the ability to really maximize Roth IRA conversions. And if that's important for you in your situation, we can look at it, but we can only look at it if we actually truly sit down and do that and evaluate your tax returns. And so what I'm mostly concerned about is I'm not as concerned about the equity markets and what is going on with the equity markets and what could possibly go on with the equity markets, as much as I am truly concerned about you. And if your time frames have changed, if your need of your assets have shortened, or if your risk tolerance has changed, where we used to be more aggressive and now, Chris, yeah, we just want to be more conservative and safe. We can do that for you. So don't be afraid to talk with us and sit down, and we can have Zoom meetings where we're meeting on this sort of format individually, or we can meet, we can talk on the phone. We can, with a flick of a button, just change your volatility if you've had time frame changes in your time frames. Long term, we really want everybody to be long-term investors, and let us worry about your exposure to risk. And as you can see in the chart behind me, we have financial guidance to help you enjoy life more and worry less. Part of that worry less is to make sure that we don't lose money in the long term. And short-term volatility happens, but making sure that you're long-term investors is an important strategy to keep in mind. And we're not trying to scare anybody. We are here to prepare you, not scare you. And so we are proceeding with caution. And that caution is we are watching these accounts, your accounts, on a daily basis. And so some key takeaways. The first half of 2020 has been a wild ride. I have been doing this for a long time. We have never seen that big of a drop that fast, and we've never seen that big of a recovery that fast. And so it's important to realize that we had a wild ride. Volatility has emerged, but all of that is not as important as your health. And so I hope you're taking good care of yourself, and it's a beautiful summer. Get out there and do some walks. It's one of the best things you can do. Focus on your personal goals, and call us with any questions or concerns. And in fact, one of the things that have happened, this has been an opportunity for us to upgrade our tech and upgrade our technology. And there's a ton of things that we've been doing. And one that I'm super excited about is our financial planning program. And this is John and Jane Sample. They don't mind if we look at their stuff here. Actually, Jacob and Samantha Sample. Anyway, what this is our new financial planning program. And the financial planning program is one that shows us, it's very similar to our net worth statement that we've used in the past. And it's got future cash flows, it's got current cash flows, it has insurances and everything worked into it, and that's on the one side. The next program is the retirement planning program that we use, that we are so excited about. One of the changes that works with this program is that I was always doing everything in gross dollar amounts and gross numbers, and then we would subtract off taxes later. This program looks at things a little differently, and it actually goes net of tax, or it's after tax. Here's how much we actually have. And because what I found, and one of the things that makes sense, is someone wants $1,000 a month. They actually want $1,000 a month, not $1,200 a month, and then let's subtract off taxes, getting $1,000. And so it's a little different philosophy, but it really is great. And once we get all of your stuff into this program, we can, with a click of a button, pick alternate retirement dates. We could show what happens if one of you passes away. We could show what happens if one of you end up in a nursing home. With a click of a button, we can just show you, here's what happens. And we have found the tools associated with this program is amazing, and we are so excited to share this with you. And in fact, I've been making a video every week since the end of March, and I'm assuming you've been receiving them. One of the upsides of doing these weekly videos, and they're shorter, 3 minutes or whatever, is that you get to kind of stay up to date with everything that's going on. One of the downsides from our perspective is the idea that we don't get to see you as often as as we want. I talked to my dad, and he was like, no, I know what's going on with the markets because you've been keeping us up to date, so I don't feel like a review. And that's, I get it. But it is important to understand that putting together some retirement planning things, looking at your exposures to risk and other things, but most importantly, looking at your taxes. This year we did over 100 tax returns for our clients, and that has been a great blessing that we can take a look, and we were able to find things that weren't there before, and save a lot of people a lot of money. And so what you can expect from us is regular communication. I'm going to keep making these videos until you guys quit watching them. I'm going to do some more frequent discussions. In fact, last week's video, I was talking about the idea of if you would like a summation of what happened for the quarter on a quarterly basis, or if you'd prefer to have an interactive webinar such as this. And it was overwhelming that everyone was like, Chris, just kind of tell us what's going on. And so I was trying to time that quarterly sort of market review around when you get your statements. The problem is there's been a lot of delays this quarter, largely because of the COVID-19 staffing issues back in the home office, because we were supposed to all have our statements back on about the 20th of August, and I still don't even have mine. I had access to them on the 18th of August electronically, but the actual paper ones, my sister and mom got theirs last Thursday and Friday. So I was trying to time that review, but here's the thing, is doing a quarterly review a month after the end of the quarter just seems a little bit odd to me. So my plan is to do a quarterly review middle of the quarter, probably like the 15th of the month, giving it a week or two. So as soon as I have access to the electronic statements, then I can kind of give everybody ideas. And here's the trades that we made. Here's what's happened for the last quarter, and kind of progress that way. So if you've got any better ideas, if you'd rather me wait until the end of the beginning of the following month to do this, I can, but I think it'd be better, more timely if we did them closer to the end of the quarter. So I plan on making these videos about the markets and how we've traded and what we've done on a quarterly basis. So I've kept you for a half an hour. Thank you everybody for signing up, and here's the deal is I know that you are well taken care of. I know that you've got questions, because if you do, you call, and that's great. And we encourage that. We want to make sure that we're following our path to make sure that everyone enjoys life more and worries less. Your friends, neighbors, relatives are not getting that same level of care. And there was a recent survey that was talking that 32% of clients have not heard from their investment guy since the beginning of March. And that being said, that means that 1 out of 2 or 3 of your friends don't have the same sort of information that on a consistent weekly basis that you guys are getting. So don't keep us a stranger. Tell your friends, neighbors, and relatives about that. And I got a couple questions coming through here. One, how do you see the elections? How do you see the election as affecting the markets? And obviously there'll be winners and losers regardless of who wins. Will this be something that will impact our approach to investments through the end of the year? That's a great question. And actually about 2 weeks ago, I got my first election call. And that election call is, Chris, if so-and-so gets elected, the markets are going to crash. And I can always tell, which way they're leaning based on how they phrase that. And before the last election in 2016, we had a very similar sort of questions coming in. It was closer to September and October when we got a lot of those questions and concerns. And in 2016 was a fun year because in the beginning of the year, between January 1 and February 11th, the market had dropped a ton. And we were very conservative and had taken people out of the markets. And so as the market rebounded, we were participating in that, and with the elections, we will use the same sort of philosophy we did back then, and that was the last time, how far, if so-and-so becomes president, whoever that is if how far is the market going to drop? Because if the market's going to drop 30% because of a president, or 20% because of a president, or 10 or 50%, how much power does a president have? And so, let's say we say, oh, the market's going to drop 20%. Well, we can say the last time the market dropped 20%, less than a year ago, your accounts only came down this much because we were very conservative and took it out. So to be honest with you, from an election perspective, we're going to go with the flow. And the effect that it'll have is going to be based on the signals that we get from our investment research firm. And if we have a big blue wave this fall, it will affect the markets, it will affect taxes, it will affect everything. If we have a red wave this fall, it will affect the market, it will affect taxes, it'll affect everything. And so to answer your question, does it change how we do things? Not really. We're very systematic in how we do things, and we don't use feelings. If there's anything that this COVID-19 crisis has done is it's proven the point that feelings can wreck your retirement. And so we don't use feelings. We're using numbers and logic, and we're going to, it's interesting. Last election, when President Trump came in, he ran on dismantling healthcare, and so healthcare went straight to the bottom. And it wasn't that there was anything wrong with healthcare, it's the fact that no one knew what was going to happen. There was a mystery, with the new president and how he ran and what, he said he was going to do. And of course, nothing happened to healthcare. And it finally rose back, and it's one of our top holdings today. And so that's a good example of how things have, how things evolve and how things change. And it does become part of the investment weighting scale that we use to decide what to invest in, and also it is part of the impact of what percentage we should have. So the last thing is I wanted to let everybody know I've been writing a book, and I'm putting the finishing touches on this book. You didn't know I was an author. I didn't know I was an author. I decided to write the book called The Consumer's Guide to Estate Planning in Wisconsin. And I'm kind of excited about this. The book is, we're putting our finishing touches on it. When I get it done, my intent is I'm going to mail every one of you a copy of this book for you to read and give it to your friends. And it's full of stories and things that I've seen over the years, and it really, I hope you'll like it. It's not a 40,000 word, 200-page novel. It's definitely a simpler, easier read. It's about estate planning, and I hope everybody likes it. And I'm hoping to get it all done and printed it out before the end of the year, but printing takes time, and especially with this environment that we're in. So Heather and Brenna are great, doing great here. Jordan is doing well. We've got Rhonda and Debbie and Cheryl are all working remotely and working from homes, and everything is good here. I hope you guys are good. Expect our weekly videos that are going to be coming out, and our newsletters that are coming out. And again, thank you so much for your business. I really do appreciate everything. Feel free to give me a call anytime if you have questions. Again, thanks.